What's up, everybody? Welcome to wealthyjoes.com. Making another video for you guys. You guys gave me a lot of support on the multifamily video that I put out there, how to buy rental properties, a fourplex for only $500. I really do appreciate the support. I saw some of the comments that you guys made, some things like how do you get started? Did you need good credit? So it kind of inspired me to create a video that's very basic. It starts with the principles of wealth and money making and assets, liabilities, and what you need to know in order to really understand why you're investing in real estate to begin with, and take advantage of some of the opportunities like a VA loan. People are starting to wake up to the idea that nothing's really guaranteed. Jobs in the United States, we had almost 25% unemployment with the COVID-19. People are stuck in their houses, and some of them have no way to pay their bills. So they're starting to wake up to the fact that they need to figure out different income sources. How do they get a passive income? And this video is all about teaching you the principles that will get you there. So let's just jump straight into it. Let's see here. What is wealth? Okay, so wealth is when passive income exceeds your expenses. We'll break this down. Passive income, money that you make when you don't need to be there. So whether you go on vacation or you're working, you're still receiving that income. You don't have to be present and to receive that income. It's something that your assets continually pushing out money to you every single month. And then your expenses are what you're spending every single month for whatever lifestyle you have. Those expenses, food, utilities, your car payment, gas, your phone bill, all those things that keep you going on the lifestyle that you've become accustomed to. And when you're wealthy is when you have passive income, you have other income sources that don't require you to necessarily work at them, that are paying those. And once they exceed the total amount of your expenses, you'd be considered wealthy. All right, so income and expenses, simple concept. How much money you're pulling in, and your expenses, how much money's going out, right? And then the biggest thing here is understanding the difference between assets and liabilities. So by definition, an asset is anything that helps you or supports you, something that's good for you. And a liability is anything that's a danger or a threat to you. And in this case, in your financial health, something that's an asset for your financial health and a liability for your financial health. It's the same concept. In this case, anything that puts money in your pocket versus anything that takes money from your pocket. So you have assets like real estate, rental income, savings account, TSP, the interest that goes from those, that's considered an asset because you're deriving income from that. Stock dividends, if you have stock in Microsoft and it's paying you a dividend quarterly, that's considered passive income. And then you have liabilities on the opposite spectrum of that: car, motorcycle, boats, ATVs, those loans that you're constantly pushing money out to. And the reason they're liabilities is because they don't give you anything back. You're paying for them every single month, but they're not putting anything back into your account. Your rental lease, you're just pushing that money out to your landlords, houses. Now, the reason I put both for a house is because, yeah, it's an asset. You're building equity in that loan, and people think that it's their greatest asset, but it's a liability in the fact that you're pushing money out every single month. Not only for the loan, but also for your maintenance. And anybody who's a homeowner knows that it's a pain. You're paying for all the air filters, light bulbs, lawn care. It's a very expensive thing, and it's a liability at the same time. So I also have here good debt and bad debt. People think that debt is always something that's bad. However, it's just not the case. So a good debt would be something that pays you in return, and bad debt is just taking money from you. So, for example, I would make you a deal. I'll loan you $5,000 and you pay me back $50 a month every month. That seems like a pretty decent deal. It's not too bad, right? But on the opposite, you have, let's say I give you $5,000 and you receive $100 for that, but you still have to pay me $50 a month. So you see how that's better debt, because you're receiving $100 a month for something that you bought with that $500 $5,000 and you're paying me $50 a month. So you're making $50 every time, every month for that $5,000 asset, whatever you bought. That's the difference between asset and liability, good debt and bad debt. I hope that point's clear. I made this little chart here, this little graphic to help you understand why buying an asset is good for your overall wealth and your net worth versus buying liabilities. So wealthy people buy assets and poor people buy liabilities. It's just the way it works. I'll jump into this graphic so it can help you understand. So you take your money and you purchase an asset, right? So that's going to start to drive that crank, that wheel, and increase your income. And that increased income is going to drive your overall wealth, and it's going to continually increase your wealth, which from that wealth, you can actually take that money and purchase more assets. So it's a continual growth cycle. You know, it's something that can grow and feed itself versus when you buy a liability, right? So you purchase your liability and it feeds that expense column. It's something that's coming out of your pocket every single month. The more liabilities you have, the more expenses you have, and the faster you're going to go to broke. The difference between this asset cash flow graphic and the liability one is there's nothing on the other spectrum of broke. There's nothing coming out of this. There's nothing on the other side of this gear that's going to be able to come back and help you buy more liabilities or assets. There's nothing. If you were to lose your job or your spouse was to lose their job, there's nothing that's going to help you come out of this situation. So your net worth is just going down the tubes. So obviously you want to be on this side. You want to start to grow your net worth and purchase assets steadily. So 3 things to get started. You need to save money. Without having a little bit of money, there's no way for you to buy assets. There's no way for you to build your net worth. Okay, so pay yourself first. Start treating yourself like a business entity. Start with at least 10% of your income should be attributed to your net worth, right? Something that you're building over time. And I'm not saying just save up this money and then buy an amazing car afterwards. That would defeat the point. It's your wealth fund. It's your nest egg. Something that you should look 300 years in the future. Something that it should be an asset that your grandkids inherit, right? So you have to look at it from that perspective. You need to clean up your credit. I can't stress enough how important having good credit can help facilitate investment. There's a lot of ways to do this. One being get your credit report. The 3 credit reporting agencies, TransUnion, Equifax, and Experian, they will all give you a free credit report every year. You're entitled to it. It'll have a list of all your creditors on there, and you can start to just tackle it one by one. Start with the smallest creditor first, whoever you owe the least amount of money to, and just start working your way up that list. And you'll see that your credit score will slowly improve over time. There's also, debt consolidation loans. If you made a mistake and you bought a car that's costing you, 12%, God forbid 20% interest, you can get a debt consolidation loan at a reasonable rate. Something that's less than 5% would be considered a reasonable rate, and you can pay less interest on that principal that you borrowed. And there's a lot of different lenders out there, if you have decent credit, that will be willing to lend you a personal loan to clean up your debt and do some consolidation. And the third thing is start buying assets. Doesn't matter how big or small, you need to just start building that column one by one. Whether it's a few shares of stock, whether it's putting money in that TSP every month or into a savings account, buying some silver, gold. Just start building that asset column. And I'm not against buying liabilities. I'm not against buying, cars and boats and all those things. But it's a matter of priorities, right? So you shouldn't be continually buying liabilities if you don't have any assets, right? So you need to prioritize buying assets first and let the assets pay for those liabilities, right? Okay. So what else we got here? Why real estate? Okay, this is my bread and butter right here. I could talk about real estate for hours on end, which is why I'm doing these videos, just so someone out there will listen to me. The reason why I love real estate as the best asset for me is that it's a tangible asset. It's a hard asset. If for whatever reason, the investment isn't paying you monthly, you can go in there and you can get your hands dirty, and you can fix the problem, right? And you can fix that investment so that it pays you monthly. Whereas, if I buy stock and if I have 100 shares of Microsoft and Microsoft announces that it's going bankrupt, and that stock is worth 90% less than what it was when I bought it, there's nothing I can do there. It's just money gone out the window. Versus real estate, where it's something that's tangible and something I can kind of facilitate and control, something that I can put a little bit of money into, make a little bit more, better looking, something that's more attractive to renters, more comfortable for renters, and gain more income. It has more growth potential that I can facilitate. But more than that is the cash flow that I receive from that every single month, right? So the positive cash flow that I get from rental properties is the most important aspect for me. It's something that goes into my bank account every single month. At this point, with my rental properties, I'm making more than $1,000 a month of extra additional income. And on top of that, I'm building equity in those loans. So what I mean by that is I'm paying off that loan, but I'm not paying it off with my own income. I'm not paying off with my own BAH. I'm not paying out of pocket to pay off that loan. It's coming from the rental income that I'm receiving, and then I'm paying off that loan. So it has long-term growth, long-term wealth building for when I either cash out of the property, sell it, if I want to keep it, and then derive more income from it. But so I have short-term and long-term wealth building from one asset. So it's kind of two birds with one stone. And then in addition to that, you have the tax benefits from it. So according to the tax law in the United States, real estate is considered a depreciating asset. Whether it appreciates in the market or not, the tax law is saying every year real estate depreciates, meaning it's worth less, so you get a deduction on your taxes. So, and then everything that you invest in that house, so if you pay to fix it up, if you pay a property manager, if you pay for some supplies to fix that house up, those are all things that you can deduct off your taxes that will help you get money back on your tax return. And then most importantly, for if you're a veteran listening to this and you're debating whether to use a VA loan to invest in real estate, is the cash on cash ROI, right? So return on investment, if you don't know what that means. So investors would kill to have 0% financing to buy multifamily apartment buildings. It's something that's just not out there to anyone, and it's a huge advantage that the military has. It's just like TA. So if you don't use your tuition assistance to educate yourself, you're just wasting that opportunity. It's the same thing for a VA loan. If you're not looking for opportunities to use that VA loan to purchase real estate for yourself and build your asset column in that respect, you're just kind of wasting an advantage that you have that not many people have, something that can help you build your net worth over time. So it's something that you should take advantage of. And I'll do my best to help you learn how to utilize the VA loan, get the best possible investment that gives you the best amount of cash flow possible, and I'll teach you exactly all that I know about that over time. So review 3 steps. So stash some cash, at least 10% of your income. There's no cap. You can stash as much as you want of your income that that you can. Clean up your credit and buy assets like multifamily real estate. Most importantly, watch my videos and learn how to do that, purchasing multifamily properties with your VA loan, and start building that asset column and increase your net worth. So that's what we're doing here at Wealthy Joe's. I hope you enjoyed this video. Go to wealthyjoes.com. I have all the books that I've read over my lifespan, really, things that taught me the fundamentals. And you can find those at my website, wealthyjoes.com. Like, subscribe, write a comment or question, check the links below. I'll include some links on, how to save money, how to clean up your credit. So thanks for tuning in. Take care.